Hello guys, welcome to Co Academy, and in this video we'll be talking about a very important terminology in finance, that is corporate finance. What is corporate finance? Students often hear this terminology but they get confused as to what is the exact meaning of this. So without further ado, let's start. So remember that corporate finance or corporate finance activities in a business are headed by a chief financial officer or CFO, and it has three basic functions. Number one is capital investment or investment function. Number two is capital financing or financing function. And number three, dividend and return on capital. That is how the dividend and returns are to be paid back to the shareholders. So we will discuss each of these in part. So what is capital investment function in a corporate finance? This is when the business decides whether to expand or not. That is whether to undertake a new project or not. For example, expansion of factory or acquisition of a new business, funds are required for this. So business basically decides whether this new expansion is going to be profitable or not, and whether it is going to be risky or not. So the business analyzes that new potential project from different angles. That is how much return is expected out of this, and after how many years can the return be expected, what are the risks associated with this project. So analyzing a potential new project from these angles is called investment function. And of course, if the risk adjusted return of a potential project is quite high, then the business will go ahead with the project. But if the returns or risk adjusted returns, that is, risks are high but the returns are relatively low, then the business will not undertake that new project. So this is called investment function, and this is the first function of corporate finance. Second is capital financing or financing function. This is when, suppose you decide that okay, you are going to undertake a project, for example a project of 1 billion rupees or dollars, then you have to raise funding for that. So there could be like three ways. For example, you have to take loans from a business, which is relatively difficult, or you can issue bonds, or you can issue shares. So there are various considerations when deciding which source of finance to go for. For example, bonds. In the case of bonds, interest is a tax expense. So you get tax savings when raising finance through loans and bonds. But these loans and bonds, they are essentially your liabilities, and the credit worthiness of a business gets affected with these. On the other hand, if you raise money through equity, then equity does not affect the credit worthiness of a business, but raising capital through equity is relatively expensive. So you have to keep a balance and maintain an optimal capital structure to make sure that you have your business has liquidity, do not face liquidity issues, as well as it saves money from this. So once you decide in the first step that you are going to undertake a project, the second step is how to finance that project, and third is dividends and return on capital. Of course, when you raise finance through different sources, for example, when you raise finance through bonds, you have to pay interest. When you raise finance through issuance of new shares, you will have to pay dividends. Now the function of corporate finance is deciding how much dividend to pay, whether to pay the dividend now or to pay it after few years. So this is the third function, that when to pay back the investors or the bondholders or the lenders, after how many time to pay. And this is essentially the third function. So some people also say that the corporate finance function also include like short-term cash flow management, long-term tax benefits management, and certain other financial accounting. But keep in mind that these are the three core functions of corporate finance in a company. I hope you understood it. If you do liked it, do give a thumbs up and do subscribe to the channel. Thank you.